Hello everybody and welcome back to Accounting 101 with me Calvin. So we had promised to look at loan repayment schedules in this part of the sessions. So a loan repayment schedule is a plan that shows how money borrowed in terms a loan is to be repaid back to the individual or organization from which it was obtained from. So we are going to start off with loan repayment schedules. I'm going to work for you a number that shows the two different methods in which loan repayment schedules are prepared. So we're going to start with the first question, question 1. Question 1 is stating that you opt to expand your carpentry business and you have acquired a loan of 50 millions from DFCU Bank. It is to attract an interest of 10% and payable in 5 equal installments. We are required to use the reducing balance method to prepare a loan repayment schedule and to also use the fixed installments method to prepare a loan repayment schedule. So we are going to prepare two financial documents. So let me first write the question here really quick. I'm almost done. So we are required to prepare a loan repayment schedule using both the different methods of preparing a loan repayment schedule. So let me explain these two methods as I finish this. So for a reducing balance method, in this method the interest keeps on reducing as you pay up the loan. So the less money you owe, the less the interest is going to be. So in the reducing balance method, you end up paying less and less money as compared to the fixed installments method. The fixed installments method, the interest is constant, it does not increase or decrease. So the very first interest you pay is the interest you pay throughout, and it's also the easiest type of loan repayment schedule you could ever prepare. But on terms of payments, you end up paying the most money. So this is where financial IQ comes in. If you lack knowledge on how each of these documents is made, you may end up paying lots of money without even knowing. So we are going to start with the very first part. Using the reducing balance method, prepare a loan repayment schedule. So the reducing balance method, whereby our interest keeps reducing. So I think we can dive right in. So as we know, every financial document starts with a title. So right now I'm going to use OGS Carpentry Limited. Of course, OGS is the favorite. So OGS Carpentry Limited, that is going to be the first line of our loan repayment schedule. The next line is going to be saying loan repayment schedule for the amount of 50 million Ugandan shillings. This title of this document is the hardest and most important part, so please pay attention. So loan repayment schedule for the amount of 50 million shillings, and then in the next line we're going to have attracting an interest of 10% payable in 5 equal installments. This is the most complicated part of the loan repayment schedule, because you must remember to write all of this in its exact order. All these 4 lines make up the title. The moment you mess up anything, you will not get the mark for the title. So you end by saying using the reducing balance method or using the fixed balance method, basing on what you're going to use to prepare your loan repayment schedule. So for this case, we are using the reducing balance method. So we add it there as the last line of our title, using the reducing balance method. So loan repayment schedule has 6 columns, and the rows based on how many installments you'll be making. So the first column has duration, the next column has loan size in shillings, the next has principal in shillings, the next has interest in shillings, the next has book value in shillings, and the last one has balance in shillings. So book value shillings and balance in shillings. So those are 6. So since there are 5 equal installments, our duration is going to go up to 5. So 1, 2, 3, 4, 5. So make sure you rule that properly. You draw the boxes, the columns, and the rows. So we're going to start off the very first part. We put the loan size in that first area for loan size, and then the principal. Since the loan size is 50 millions, we're going to divide 50 millions by 5 equal installments. So which means every month, every time I make a payment, I will pay 10 million, 10 million, 10 million, 10 million, and finally 10 million. That should make 50 million. So the bank should get back its 50 million after the payment, after executing the loan repayment schedule. So for the interest, it says that it's going to attract an interest of 10%, but we won't calculate that immediately. We work out the balance column.